Welcome to this webcast about the current net open risk position. This is webcast 3 out of 8. This is a separate webcast to the general overview webcast and focuses on the determination of the current net open risk position, which represents the available risk to mitigate for the entity. The current net open risk position is the interest rate risk position by time bucket, which is derived from the combination of expected, i.e. modeled cash flows from assets, liabilities, including core demand deposits, and eligible future transactions over the period which the entity is managing repricing risk. It might be compared to what people understand as capacity under other available accounting models. It is, however, important to note that the current net open risk position is just that, a risk position which can be measured using different risk metrics. The capacity referred to in the general sense of hedge accounting rate is typically to a notional amount rather than the risk measure. This is an important distinction as the risk view is the basis for an entity's risk management decision, which is replicated by the DRM model. A bank typically aggregates all cash flows from the banking book into one risk position for the entity to determine its interest rate risk position over a set period of time. This can be done a number of different ways. Often, a bank operates a centralized treasury unit and only transfers the benchmark interest rate risk to the treasury unit, which is managing the bank's overall risk position.
The current net open risk position tries to replicate this holistic risk position used for interest rate management as closely as possible, thereby recognizing that not all items included by risk management are eligible for inclusion in the DRM model. For items which are currently not eligible for designation in the model, for example equity, there might be a deviation to the risk position that risk managers use to execute derivatives with external counterparties. The objective of the DRM model is to keep the current net open risk position as closely as possible to the position risk managers actually use for decision making in order to better reflect the activities and consequences of risk management in financial statements. Some stakeholders questioned whether designated derivatives should be forming part of an entity's net open risk position, since these derivatives are managed holistically together with other assets and liabilities. However, the current net open risk position is defined to determine the organic risk only, that is, the risk from financial assets and liabilities already on the entity's balance sheet, plus the risk from the future transactions. When we say organic risk, we mean risk derived from non-leveraged financial instruments such as basic lending and borrowing, which excludes risk exposure from designated derivative positions. This is important in determining the extent of risk an entity can actually use for risk mitigation. Please refer to the webcast about risk mitigation intention for more details. Therefore, the current net open risk position must be presented and calculated separately from the risk created by derivatives. The sum of the current net open risk position and the risk exposure from derivatives is an entity's residual interest rate risk position. We believe that operationally, separating organic risk should not present a challenge. All eligible items are included in the current net open risk position on the basis of an entity's risk management strategy. In other words, the entity's risk management strategy may allow expected cash flows rather than contractual cash flows. These expected cash flows are based on an entity's internal models to include, for example, forecasted prepayments or the amount of core demand deposits. The slide shows the process an entity may choose to derive a risk position from the underlying cash flow, and we will focus on the last two steps, starting with the modeling of cash flows. The expectation is that an entity uses time buckets to line up all expected cash flows. For example, if the entity uses present value of 1 basis point, PV01 risk metrics, to measure risks, the present value of all the expected cash flows is calculated once discounted with the current applicable zero curve, that is the zero or spot curve of the managed risk. It is then discounted for a second time with the same zero curve but shifted in parallel by 1 basis point. The difference is the risk exposure to interest rate risk of the entity in actual monetary terms or the sensitivity to 1 basis point change in the zero curve. This is just an example. An entity may also choose to use other risk metrics in their risk management strategy.
The current net open risk position, that is the available risk an entity can actually mitigate for accounting purposes using the DRM model, is calculated at the start of a measurement period. It will be used as the basis for the prospective assessment at the beginning of each DRM assessment period. By the way, it is important to note that a DRM assessment period does not have to correspond to a financial reporting period, although at a minimum, an entity shall perform the DRM model assessment at each reporting date. The current net open risk position will then be recalculated at the end of the DRM assessment period to reflect any unexpected changes that could have happened during the period for each time bucket, which will be used as the basis for the retrospective assessment. It's worth noting that new business generated and funding raised are excluded in this remeasurement unless they were part of the expected cash flows previously. These unexpected changes may be caused by the changes to the estimations on the amount and timing of the expected cash flows. For example, prepayments may have happened during the period or are now predicted to happen earlier than initially expected.
Thank you, Matthias. Could you elaborate further how the concept of current net open risk position interacts with the notion of residual risk or the target profile, please?
As I explained earlier, the current net open risk position is the total interest rate risk exposure from underlying assets and liabilities prior to an entity's risk management efforts. As such, it doesn't include the risk from any designated derivatives. On the other hand, the residual risk position is the open risk position after the entity's risk management activities and therefore include the risk from designated derivatives. The target profile is not a real position an entity holds. Instead, it is the range of open risk positions that an entity is willing to accept, which is the target for risk management activities. During dynamic risk management, an entity may choose to use derivatives to mitigate its current net open risk position and transform that position to a residual risk within the target profile.